board member, Dean Oliver, is going to talk a little bit about some more finance, and he's a member of the finance committee. Dean, please.
Good evening. And for those that don't know, my name is Dean Oliver again. I was appointed to the board in February of 2014 following the untimely death of Ron Martin. So that is how I got to the board, in case anyone's wondering. I want to say, first of all, thank you. Thank you for coming out. And the reason, if you go to the next slide, is if you think about the chronology and the history of this building, this is a point in time that some of us will only deal with once, maybe twice a generation. That is the financing, making an investment in the next generation of education. The building we're in since 1920s, high school 1950s. So again, it comes around once every 50, 70 years. So your involvement is vital. So thank you for being here. The reason it's vital is because of the economics of running a public school system. If you look at the pie chart above, you'll see that Shenango, we run an operating budget here of about $16 million a year. About 65% or 10 million of that is subsidized by the state. It's a redistribution of the myriad taxes that are imposed on its residents, and it comes back in the form of subsidy. The rest of the economics to the school district is in the form of local sources, which is either the real estate tax assessment or the earned income for those who are wage earners and have 0.5% of their wages sent to support the school district. So we really are beholden to the community anytime you undertake a transaction of this kind of magnitude. It is perhaps the most unique industry that you can think of, because we can't affect prices, there is no price, and we can't affect the quantity of what it is we sell or we produce to in fact have any impact on our revenues. We're entirely beholden to those two sources. And true to that obscurity is this notion of millage. Now most of us are very familiar with dollars and cents and percentages, but this concept of millage is a bit unique. And so what I want to do is just make sure everyone understands a millage is 1/1000th of a percent. So that means for every $1,000 of assessed property tax, or property value, it equates to $1 of tax collection. So on a $100,000 assessed property, it equates to $1,000 of tax. Our millage, as you see in the yellow shade, we're at 12.36 mils. That means for every $1,000 of assessed value, there's $12.36 collected and used to, again, subsidize the school's operation. For a house or a piece of property with $100,000 value, that equates to $1,236. The plan that you've listened to this point impacts your taxes. It impacts your taxes because that is the source of funding. The plan that you saw has an increase in your taxes of 4.16% over a 4-year period. What that means is that same $1,236 against a $100,000 piece of property is $1,652 4 years from now, when the full effect of that tax impact is completed. Now, the information at the bottom is really of interest, and it gets at the heart of what I would say is really the paradox of seeming to be similar. And by that I mean we seem to be similar. We seem to be similar to the Shenango, or Wilmington, or Laurel in particular. And the reason we're similar is because the size of our enrollment across any one of those four is within 100 students throughout the entire K through 12 grade system. In any one class, we're within 1 or 2, maybe a dozen students. So size-wise, we are very similar, but that really is where these similarities stop. Because when you look at some of the other economic characteristics that associate back to the sources of the revenue, you can see that we're really not so similar beyond that. Go to the next slide, please. One of the things that is among the board, among its most important responsibilities to do, is the quality of its due diligence anytime it undertakes a transaction. And I wanted to make sure that the community was aware of some of the due diligence that we've undertaken. And the first is the role of advisors. Now, the folks that are here from Public Finance Management, the engineers, the architects from HHSDR, I mean, collectively, this is a group that has 125 years of experience doing this thing. They've been involved with hundreds of transactions, and individually been involved with dozens of transactions, and they've been very vital to us as advisors. The strength of Shenango is perhaps at its all-time high. And we look a lot at the balance sheet. And the balance sheet is strong. We have what's called a fund balance, which is simply a measure of assets in relation to liabilities. Our assets are greater than liabilities. That's a good position to be in. We have about $3.8 million of fund balance, and about $2.5 million of that is in our capital reserve. And the capital reserve is effectively the result of saving over a period of time for the things that we know are going to be certain, taking care of routine repairs and capital replacements as fixtures and furniture and the insides of these facilities age. But we've over that decade that Mike alluded to, we've been purposeful to try to save what we could, to fund our depreciation, to take the debt service we no longer have and set those dollars aside. And that has really given us a position of strength from a balance sheet perspective. Zach alluded to the market factors. As a board member, this is something we spend a lot of time talking about. The quality of the interest rate environment. Not the all-time low, but it's still very favorable. And we also spend a lot of time looking at construction supply and demand. The numbers we've talked about have not been competitive to bid. We've set a scale. We think right now that the construction supply and demand favors the buyer. And again, that's what Zach was alluding to and Greer was alluding to in terms of the market factors. The debt instruments that Zach spoke about are flexible. They have some features that give us a little bit more economic impact. The three tranches that Zach mentioned two of them are designed to be bank qualified. The benefit of being bank qualified is it lowers the interest rate about 0.25%. That's real money avoided when you're borrowing money. They have a call feature that's 5 years, not the normal 8 to 10 years. What that allows us to do is take advantage of a more favorable interest rate environment should it develop in a shorter period of time. Great flexibility. These will be insured bonds. The benefit of being insured is it creates market attractiveness. When you're attracted to the market rate, that tends to drive down interest rates. And as somebody said earlier, the timing can be commensurate with when the construction occurs. Two other points that I want to just talk about that aren't up here. There's this thing called PlanCon. And Zach talked about it. PlanCon is an acronym for Planned Construction. It's a provision in the Department of Education that's designed to redistribute monies back to school districts to help subsidize, lower the burden to the property tax owners whenever these types of projects are undertaken. So we have incorporated the known provisions of PlanCon, but there is an enormous amount of debate going on at the state level about the PlanCon and increasing it to the levels that it used to be. We've only factored in that which under the current legislation is available to us. And the last comment I would make on due diligence is the estimates that have been made do not have any unreasonable assumptions around avoided costs in the future. Now, we do expect the utility consumption to be low. We expect that there will be operating efficiencies with a contiguous school rather than one that's separated by 1,000 yards. We expect those things, but because they weren't quantifiable, we didn't factor them in. The only thing that was factored in sizing this project were the operational savings that are known today. So those are my comments around the due diligence. Is there one of the other items that really became apparent last time always, what is it we're asking for? On the ballot on November 3rd is a simple statement that you see here. We're required to get community approval anytime there's the pursuit of a tax increase beyond a very de minimis amount that's allowed under the state law. This is the ballot question that you'll see. And simply, yes or no, shall we or shall we not incur debt of this magnitude? And again, this is a sizing issue, so the size, the scale has been set at 44 based on, again, all of the work of our architects and the financial characteristics I spoke about with Zach a few months ago. So anyway, those are my thoughts, and appreciate your time. Thank you.
Okay.